On Invest Like the Best, Matt, an energy investor who spent 18 months modeling every gas well and pipeline in America, laid out a thesis that should make you uncomfortable. He says the United States is sleepwalking into a natural gas crisis by 2028. Not maybe, not if things go wrong. Barring a technology breakthrough, it's already baked in. His argument goes like this. U.S. LNG export capacity is ramping from 15 billion cubic feet per day to 35 by 2030. That's locked in. The projects are permitted, financed, and under construction. At the same time, AI compute is pulling another 5 billion cubic feet of incremental gas demand in the base case, maybe 12 to 15 in the bull case. Matt's firm modeled every producing basin, every pipeline, every processing plant, every gathering system in the country. Their conclusion, we can add about 20 billion cubic feet of new production. That's enough to cover LNG exports. It is not enough to cover LNG plus AI compute plus residential and industrial demand. The gap opens in mid-2028. By 2029, gas storage drops below anything in the historical record. Prices go convex. He won't put a ceiling on it, but he mentions $10, $50, maybe higher. The host pushed back the way you'd expect. Can't we just shut off exports? Matt's answer, contract law. Japanese utilities have 20-year agreements. European allies depend on American LNG to replace Russian gas. You can break those contracts, but the geopolitical damage would be severe. Can't the Permian solve it? Matt's firm already modeled 7 billion cubic feet of new Permian pipeline capacity coming online by 2030. The Permian is an oil play. You need high oil prices to justify more drilling, and that means gasoline prices go up too. Can't we build more pipelines? One interstate gas pipeline has been built in the last 12 years, Mountain Valley. It took over a decade of litigation. The permitting regime makes fast pipeline construction almost impossible. So who wins? Matt names Expand Energy, which controls 70% of remaining core Haynesville acreage, Range Resources in Appalachia. But his more interesting call is solar. Gas sets the marginal price of electricity in every U.S. power market. When gas hits $10, solar asset owners get a windfall. Their fuel is free. Their revenue triples. Zero additional capital required. He thinks residential solar grows exponentially from here, even without tax incentives, because the economics become undeniable when electricity prices spike. And who loses? The U.S. consumer. Electricity bills could double or triple. Hyperscalers face energy costs going from 10% of their cost structure to 20 or 30%. And the manufacturers of gas turbines and fuel cells, companies like Caterpillar and Bloom Energy, may find themselves building capacity at the exact moment when gas is too expensive to justify running it. Now here's where I push back. Every commodity super squeeze narrative in modern history has been wrong about timing. Pre-2008 oil analysts predicted $200 oil by 2010. Pre-2021 lithium analysts predicted permanent scarcity. What actually happened? High prices triggered supply response, demand destruction, and substitution. The forward gas curve isn't flat at $3.50 because the market is complacent. It's flat because traders are pricing in exactly that dynamic. Prices spike, drilling ramps, demand destroys, the curve flattens. Matt himself admits the industry can add 20 billion cubic feet of production. The question is whether 2028 comes fast enough to spike prices before that supply response catches up. Maybe it does, but every "this time is different" commodity call I've seen assumes the supply response is slower than it actually is. Matt's nuclear argument has the same problem. He says AP1000 large-scale reactors are the only solution. SMRs are science experiments, he says. But AP1000s have their own track record. Vogtle 3 and 4 cost 3 times the original budget and took 15 years. He acknowledges this. His counter is that we've learned from those mistakes, and China is building 39 reactors right now. But China builds with a state-directed model that overrides NIMBY opposition and permitting delays. The United States cannot replicate that. The Nuclear Regulatory Commission exists for good reasons. If we couldn't build one AP1000 on budget in a 15-year window, betting on 4 of them coming online by 2033 is itself an unproven assumption. It's not as different from an SMR bet as Matt suggests, and the solar windfall thesis has a hidden assumption. It assumes the regulatory structure of power markets stays fixed. If gas prices spike structurally to $10 or $50, regulators will not sit still. Price caps, demand response mandates, battery storage requirements. The rules of the game change when the game becomes painful for consumers. Solar asset owners counting on a permanent margin windfall from gas-set pricing are assuming regulators will let electricity bills triple without intervening. That's a bet I wouldn't make. Here's what Matt gets right. The physical analysis is serious. Modeling every well, every pipeline, Every processing plant is not hand-waving. The timing of LNG export ramp is a real structural demand increase that most people haven't internalized. And the complacency point has merit. The gas forward curve at $3.50 into 2030 is pricing in a world that looks like today. If the physical tightness arrives even partially as he describes, the curve will move violently when utilities start hedging 2028 delivery. The knife fight for physical gas, he predicts, may not happen in 2028. It might be 2029 or 2030. But the structural mismatch between committed export capacity and domestic production capacity is real. That part isn't a forecast, it's arithmetic. What he misses is the demand-side response. Every energy crisis in American history has been solved by a combination of supply expansion, demand destruction, and substitution. The 1970s oil crisis triggered CAFE standards and a permanent shift to smaller vehicles. The 2000s gas price spike triggered the shale revolution. If 2028 plays out the way Matt describes, you won't get $15 gas for 5 years. You'll get a spike, a political crisis, a regulatory response, and an acceleration of alternatives that is faster than anyone modeled. That's how commodity markets work. The crisis is real. The permanence of it is the part to be skeptical about. That's Matt on Invest Like the Best. The full episode is about an hour. If you trade energy stocks or care about the power grid, it's worth your time. The link is in the comments. This is Rockport.